Welcome to Smart Investing. Tom Lee. Tom Lee, one of the best analysts on Wall Street, has just released a video on CNBC, and he's going to go through the markets drawdown that we've seen the last few weeks of more or less minus 10%, 15%, 20%, depending on what market you are looking at. And he's going to give his view of why he thinks that this is actually an overreaction to what is happening out there in the market and with the uncertainty with the tariffs and so on. But also what he's going to say is that usually when you have this type of drawdown, this is one of the best time to enter into the market or to DCA, because the data is showing that usually the market rebound much stronger after this type of drawdown. And after that video, I'm going to show you real market data that support this thesis, and I'm going to give you a lot of comments. So please stay tuned and stay until the end of this video. This is not going to be long, but this is a very important lesson for everybody that is listening to this video. Thank you so much. So let's watch now the video with Tom Lee, and after that we're going to comment and show you the data.
Yeah, great to see you.
Why do you say overreaction?
Well, yesterday really was an indiscriminate selling day. Did Tesla's valuation and fundamentals drop 15%? Did the broad market have a 4% decline in valuations? To us, it really looked like a lot of liquidation. I think investors are, of course, reacting to the White House warning of pain ahead, but it has been more of an equity sell-off than it has been in corporate bonds. So to us, 4% down days, yeah, I think it's an overreaction.
Yeah, how do you best explain that difference between what equities have done and what we've seen in IG and even high yield?
Well, I think on the stock side, markets are now saying, look, the new regime is we have to take the tariffs seriously. Now we don't know how long these tariffs might be. Will it hurt growth? And we've seen cuts from economists. But the bond market is saying, well, you know what? This is a growth scare. But the Fed is also now in a position to begin cutting because inflation pressures are abating. So I think the bond market is sort of pricing in a Fed put. The stock market saying, I'm not sure if there's a White House put, and then the Fed's on hold, and I think that's the divergence.
So which one should we be listening to?
Well, I think the Fed put, in fact, is probably coming back because the odds of a May cut have been inching up. They hit 54% yesterday. And, in fact, total cuts hit 3.5 cuts, which is now 2.5 or 1.5 more than the Fed's guided. But I think that the Trump put exists. I mean, I know they've explicitly said there isn't one, but look at yesterday. Tesla's down 15%, and on Truth Social, Donald Trump talks about Tesla. So I think a put exists. We just don't know the level when the White House intervenes, and then today's the Business Roundtable. We'll find out.
He does, but then he kind of ratchets up the dialogue as it pertains to the trade war this morning on Truth Social, regardless of all of the headlines surrounding tariffs and the trade war and what it means for growth and what it means for the market reaction.
That's right. And for a while, markets ignored those tariff headlines, and now they're taking it very seriously. But I think at the end of the day, if we take every headline at face value, then markets are completely paralyzed. And of course, that again creates opportunity because at some level, all these stocks are really attractive opportunities, especially something that's had a 50% drawdown.
I mean, you can talk about the NASDAQ being an overreaction at a 4% down day, but Tesla was up $500 billion in 2 months at the end of last year. I mean, was that an overreaction to the upside? This is what we're trying to figure out, right?
Yeah.
Where do we start out with in terms of valuation and investor expectations coming into this period when it's become a little bit more noisy?
Yeah, well, there used to be this term a while ago called rage selling, and I think these days with instant liquidity, markets have rage selling. And I think it's not just individual. I think institutions push a button and go flat. So I think that, we're getting whipsawed these days. And I don't know where to titrate that. Like, was Tesla worth double what it was compared to November, and now is it worth half? I'm not sure, but I think it's somewhere in between.
Meantime, there's still a lot of desk notes about CTA supply and the next 5 days. There's plenty to sell. Are you buyer that even if we bounce today, it's going to be more of a process?
Well, I think positioning does tell us we're stretched to the downside, and we know markets are oversold, and we know sentiment's bad. I guess the real tell is we need to have follow through because last week felt like we could be bottoming, and we failed Monday. But do I think that, a 10% correction, shouldn't happen? I mean, this is like the sixth correction of 8% or more since 2022, so it is pretty garden variety. But, getting down more than 10% to me is like we've got proof of a recession. And I think that that's why the data points next few weeks are going to matter.
Yeah. So if we do draw down 10, you'll want to talk again.
Yes.
Okay. Tom,
We're
thanks.
close, yeah.
Well, maybe before. Tom Lee, thanks so much.
What the very important point I want to take out from this video is a few things. First is the Fed put. The Fed put is basically that after the latest inflation report that we've actually had this week, we saw the inflation is less than expected. So that means the Fed has more room to decrease rate. And I showed you on the previous video that the market, the overall market on Fed Watch, you go on the website Fed Fund Watch, the market is pricing actually more rate cut than the Fed is expecting. So this is what we call the Fed put. Any growth scare or any worry on the macro side of the economy, then the Fed is going to decrease rate. That's a put for the stock market, because the stock market love rate decrease, because it helps the growth stock actually go back up. So let's look at the data up there. So the second thing that he's saying is that what he's saying also is that he said over the last 6 times that we had a market correction of 10%. Every single time the market went higher. After the 1 month period, after the 3 months period, after the 6 months period, after the 12 months period. 5 out of 6 times, except for the COVID, the market went higher 1 month later. Actually higher than the level before the crash. That's what we mean. That means that the peak to trough, and then after come back to the peak after 1 month. 6 out of 6 times higher 3 months later, with a medium gain of 9%. 6 out of 6 times higher 6 months later by a medium gain of 15%, and 6 of 6 times higher over the 12 months later with a medium gain of 21%. So basically, the history is telling you that 100% chance after a drawdown of 10%, except during exceptional circumstances like the COVID time, you are playing the rebound of the market, and the return after that crash is actually staggering. I mean, over 1 year, 21% after the crash, 21% is an extremely good return for one year time frame. So don't miss the opportunity. Don't take the market drawdown as the reason to flee the market. This is a reason to stay in the market, even to add to the market and to add to your position in DCA. Take the opportunity of a stock being on sales. You don't go shopping when the price go up. You go shopping when the price go down. The stock market is the same. Nothing has changed 2 months ago and today on the fundamental of the companies that you are investing into. Nothing has changed with Tesla, Palantir, or the companies in the QQQ, the company in the 500, S&P 500, or the company on the small cap. Nothing has changed. Fundamentally speaking, nothing has changed. 2 months difference, nothing has changed. Just the price has changed. It's much cheaper, sometimes much cheaper than 50%, 40%, 30%, 20%, 10%. So this is basically the sales time to take the opportunity to buy cheaper the company you like or the index you like. Let's look also the reason why you shouldn't sell and panic sell during correction in the market, or like why there is always a reason to sell. This is a chart since 2009, and it shows you clearly there are always reason to sell. Always there is a reason to sell. You want to sell, you see, there is always a reason to sell. But if you sold at those times because of headlines, because of fear, because of mainstream media trying to put fear in your body, this is their job. They want to scare you because they make money out of your fear. But every single time the market went up and up and up and up and up and up and up. Over the long run, the market always go up. This is a positive drift instrument, especially if you invest in indices. If you invest in individual stocks, stock can go down even forever and go bankrupt. But if you invest in an index, it will never go down. Never go down over the long term. It will always go up. That's for sure, 100%. So now, you wanna understand how frequent it is to have drawdown of 5% or worse. Look at this chart. Drawdown of 5% or worse, 94% of the time. 94% of the time, every single year, you're going to have a drawdown of 5% or worse. 64% of the time, you're going to have a drawdown of 10% or worse. 40% of the time, every single year, you're going to have a 15% or worse drawdown. 26% of the time, every single year, you're going to get a correction of 20% or worse. Look in 2023 and 2024, we had a very good up market, but still we had correction of 15-10%, few times. Those who have been invested in 23-24, you know the market has been extremely good. Extremely good. But that didn't mean that we didn't have a correction of 10% or more. And each time this happened, if you bought after the drawdown, then you would be extremely good in your portfolio. You will see a lot of red. I mean, the stock market is a character test, you know. You need to withstand the red to be able to see a lot of green in the portfolio. You should understand that seeing red in your portfolio is part of the process. It's actually the price you have to pay to make money. It will be too easy if it was always green in your portfolio. You need to withstand the fear. You need to withstand, you need to have a lot of virtue to be a good investor. And certainly not panic for everything that is happening on every headline that is happening, because there will be always headline. As you've seen in the previous chart, there is always a reason to sell. But there are many more reasons to buy and not to be fearful and run for the exit. So the most important message I want to tell you with this video is don't panic. Stay with me. Subscribe to the channel. Like the channel. Make a comment. Let's build a community where we can support each other and make money over the long term each other. I've made money. I've made a lot of money in the stock market. As a professional investor working for a large institution and even for myself. Now I have a lot of freedom. I can do what I want. I can work, not work. I can take the job I want. I can do a lot of things, you know, because I control my emotion. I don't overreact for anything that is happening in the market. I understand the game. I understand the rule of the game. And I want you to benefit from my experience. And please, don't panic. Control your emotion. This is an opportunity to buy. Over the long run, DCA, try to make more money, more income than expenses. Don't overspend all your money. Make more money than you spend. And then the difference, you automatically invest in the stock market. Again. After 10 years, you will be surprised how much money you're going to make. The more money you have, the more money you will make. If you do a 10% of 1,000 or 10,000, this is nothing compared to 10% on 1 million. Or 500,000. Do you know? So please, try to be disciplined, control your emotion. Join me. We're going to go through this journey together. And I thank you so much for you listening to this video. And I say goodbye and see you next time. Bye.